Welcome. These sessions will be recorded. I am pleased you could join us for the Business Education and Resilience webinars with 1917. My name is Pauline Marquardt, and I'm the Executive Director of the Greater Bowie Chamber of Commerce, which is made up of members with common interests and concerns related to the business environment in the Bowie area. It is the primary professional trade organization in the Greater Bowie area dedicated to the protection, enhancement, and success of businesses in the Bowie community. The Bowie COVID-19 Business Recovery Assistance Program delivers online technical assistance to help Bowie businesses accelerate their post-pandemic economic recovery. This program is a collaboration between the Greater Bowie Chamber of Commerce and the Bowie Business Innovation Center Business Accelerator, and funded by the City of Bowie. During this webinar, it's best to be comfortable with your video on. Remember to mute yourself. Please ask questions through the chat unless otherwise directed. Joining us this evening is Eric Lindsay, Senior Business Counselor of 1917. Welcome, Eric.
Good evening, Pauline. How are you tonight?
Very good, thank you.
Good,
so glad you could be here.
No, always good to be here. Just wanted to give a brief present introduction to everyone. Good evening, everyone, for being here. Also, I have my colleague and good friend, Mr. Charles Motte, who will be leading the presentation this evening. And it's going to be a great session. Charles has a lot of information. It's a great follow-up from last week from what he talked about. And it's a build-up from last week into this week. And then this week, his build-up will be into the next presenter for next week. So all these webinars sort of connect, and they're interdependent of each other. So before we move forward, I just want to say thank you to the Greater Bowie Chamber of Commerce for selecting my company and all of my colleagues that I work with in presenting these virtual business sessions to the businesses in Bowie. So we definitely look forward to moving through all of these 25 webinars. So again, this is the Business Education and Resilience webinar series. This is a 2-section, 12-part webinar series for a total of 24 sessions. So there's a lot of opportunity for people to learn, to jump in and jump off and look at their particular, to enjoy their particular subject matter area that they would like to have more focus on. But to get the full spectrum of what we're talking about, it's always good to join all of the sessions. So again, we're taking a programmatic approach. So it's one webinar builds upon the other. Like Charles was on last week, and he's continuing his conversation into this week, which will be a deeper dive of what he talked about last week. So we're looking forward to tonight's presentation. So we're definitely talking, we started off with goal setting, and we're going to go through goal setting, which was one of the first webinars. Right now, we're talking about financial literacy. We'll be doing some QuickBooks training. We're going to be doing some managing team training. We're going to be talking about sales and marketing and operations, and even how to exit your business. So this is why it's such a long 24, 25 webinar series. We're also going to get a few updates from a federal colleague of Charles and I. His name is Rod. He works for SBA. He's going to give us an update on the PPP and the EIDL programs that have been renewed for 2021. And then the grand finale is on July 15th, where we'll have a Pitch Your Business competition. This is a voluntary competition. We want as many businesses to sign up for it. You obviously sign up through what you signed in to register for this event. Pauline is going to definitely share that on the website. And then everyone will have an opportunity to pitch their business and present and ask for what they're asking us, who's going to be judging it, to take you through that process. We will select the first place winner. They'll receive a great prize. I'm working with a colleague we're actually putting that prize together. And from what I'm seeing and what we're putting together, it's going to be pretty cool. It'll definitely grow your business. That's the idea. And actually, my pitch to you tonight is to please sign up and return for all of the webinars. Just come with a sponge of a mind and just, ask a lot of questions and just, listen to what we're saying and challenge us. Give us hard questions. That's why we're here. That's why we're here. We're good at what we do, but we're not gods at what we do. We are good and we are experts, but at the same time, challenge us, because that's what makes all of us better. Because we're going to ask you questions whenever we have an opportunity as well, because by learning with each other is the best way to learn. So, Charles and I, we're business owners ourselves. We work together, and, we learn something new every day. And this is why we're doing this. All of the colleagues that I'm doing this with, we're all business owners, all of us, and we all learn with each other and from each other. So ask those questions. This is what makes all these webinars really wonderful, by having all of you here and really just engaging. So ask the questions in the chat. Pauline and I will take a look at that, and we'll go ahead and send those to Charles, who's presenting tonight. And Charles will definitely have a lot of answers for you. So with that, I'm going to turn it over to my friend Charles, my colleague Charles, and he will go through his presentation, and we look forward to the second part of financial literacy. So Charles.
Eric, thank you so much. Pauline, again, thanks to the Greater Bowie Chamber of Commerce. Appreciate your support on this and your efforts in terms of helping spread the knowledge about all the tools that are necessary to keep your business going or starting your business up. So that, as Eric said, this is a continuation of last week. We talked about financial tools, financial statements, and financial literacy. We covered more than just the financial statements, but specifically tonight, we're going to focus on just financial statements and talk about some of the intricacies there and things to understand. So first, I'm going to, there we go. First, we're going to put a little disclaimer up there. All the information that we're providing tonight is for informational purposes only. It doesn't constitute legal or professional advice. It is, in essence, you're encouraged to, while taking this information in, to seek, professional help to help guide you on this specific topic and on others that we've presented through this series. A little bit about myself. I'm currently the Associate Director with the District of Columbia DC Small Business Development Center. In my past, I have been an owner of a business, a co-owner, a regional manager, team leader, and project manager. And in those different roles, I've learned so much about small business. I actually started out in aerospace as an engineer. I was in that for 9 years and then migrated into small business from there. Obviously, totally different experiences, but I learned a lot from both and have been able to learn from those takeaways. And as Eric said, we're not gods, and in many cases, all of us as business owners have learned a lot from, we've had a lot of lessons learned and learned from the mistakes that we've made and the successes, but oftentimes it's the mistakes we made that help us become even better. As indicated on the slide, I have over 25 years of experience working in or with small businesses. Last year in my current duty, I counsel over 112 clients, small business clients. So every day, as Eric said, we learn something new. We learn something that enhances our knowledge, and hopefully we've enhanced the knowledge of the clients we work with. I also serve on several nonprofit boards, so I do have a balanced experience of in my portfolio of large business, small business, and nonprofit. Move on to the next slide. This is a quote that I really like because I think it encapsulates in many ways the small business owner. You're not obligated to win, but you're obligated to keep trying to do the best you can every day. And I think that's the key thing with being a business owner, that you'll have ups, you'll have downs, but the key thing is to keep moving forward and keep progressing your dream and your business. So let's talk a little bit about the takeaways from tonight's presentation. What I'd like you to take away from this presentation. So really there's 4 things. I want you to understand the language and use of financial statements. Just like anything else, this topic has a language unto itself, and there's certain nuances, and we're going to talk about those nuances in the presentation. And also, it's important to set up your books, your information with the right information up front. If you don't do that, oftentimes you have to go back and correct it, and it can be challenging to do that. So that's another takeaway there. Decision making also is important. Correct financial statements or good information allows you to make decisions about how to move forward. whether you're a startup business or whether you're an existing business. And lastly, having the right accounting system in place. Many are going through the pandemic right now, many business owners, and that has been one of their challenges if they didn't have really good books in place, is to put that information together so that they can receive either grants or disaster loans and so on. We're going to talk a little bit about the pandemic. This has been obviously without state, this is an understatement, but last year was definitely a challenging year, and this year is a start of a new challenging year, hopefully with some light at the end of the tunnel for either new business owners or existing business owners. Self-employment and working and self-employed and those who are working in that arena has gone down over the past year and projected into this year. Employment in leisure and hospitality is down. And another indicator is the applications for EIN; those have gone down. So it's been a challenging year, but there is a silver lining to this. Many businesses who have suffered through the pandemic have used this time to pivot their product or services, and in some cases, some businesses are actually doing better than they did before the pandemic. It's not in all cases. Many businesses will fail or have failed, but many businesses have been able to successfully make changes. Part of it is based upon the subject we're talking about tonight, and that's their financial statements, making decisions based upon historical data and planning for the future through their forecasts, which we're going to discuss. Many businesses during this time have leveraged disaster loans and other types of loan products to help them move their business, keep their business sustained and moving forward so they haven't succumbed. And many are reevaluating and investing in better operational processes and tools. This means that they've looked at how they've done business in the past and realized that that hasn't been effective for them. They're going to have to change the way they do things. And many businesses, especially in the role that Eric and myself in our day positions deal with, we deal with many businesses who are making those decisions and looking to change the way they do business. Also, financials and financial statements, along with doing a SWOT analysis, and we're going to talk about what a SWOT is later on in the presentation. They've been able to use both of those to make really good financial decisions, or decisions that help them maintain or even grow their business despite the pandemic. Of course, just being in business by yourself. So where I left off, we had just talked about the good news related to the pandemic. And the last thing I believe I mentioned before we dropped out there was the importance of seeking advisory and counseling services. And we're going to talk a little bit about that later in the presentation and what's available to you as small business owners. We want to emphasize that you're not in business by yourself, but for yourself. And there are a lot of support mechanisms and counseling that are available to help you, with your business as you move forward, whether you're a new business or an existing business that's been around for a bit. So we're going to talk about the business life cycle here to get a perspective on this relative to the subject that we're talking about. So if you're just starting out and you're launching your business, the importance of the financial statements in that sense is that you're going to use them to do some forecasting. You're going to basically put some numbers down to help basically test your hypothesis about your business, whether it be your profit and loss, or whether it be your cash flow. In the beginning, when you launch the business, you're going to be putting this information in there with the best estimate of how you think the business will perform, which will give you indications and also help you make any modifications that you may need to make with regards to the numbers to make sure that you're generating a profit. As your business grows and expands, and we all hope that all businesses grow and expand, as you move to different stages, your financials play a different role at different times, and it will help you with different decision making. And this next slide shows, kind of what that means at different times in the business. So as I mentioned before, there's the forecasting aspect of looking at the viability and sustainability of your business. And we typically call forecasting type of statements pro forma statements. You'll see those on the statements themselves, whether it be an income statement, a balance sheet, or a cash flow statement. They'll use the term pro forma, meaning that they are projected numbers. That term is taken off if you're talking about historical numbers. And if you're an existing business, you look at your past data, your historical statements, in the context of looking to help you make better decisions. And those decisions might be related to making corrections with the business, making decisions about expansion and growth. For instance, maybe you've looked at your profit and loss and you have sufficient cash to maybe open a second location or expand your production capability. And then lastly, you can also use these financial statements, the historical statements, or even your forecasted statements to look at industry comparisons. There are many companies out there that put data together that provide aggregate data about given industries. And you can compare your numbers with those industry comparisons and see if they line up. For instance, do I have a lot more cash, relatively speaking, on my balance sheet than most other firms of similar size and revenue? So decisions like that can be part of what helps you later on, or to see where you are relative to other firms. So this is always an analogy I use with my small business clients, and that what you get from your financial statements, you essentially work as a dashboard. They're giving you a lot of information about the condition of your company as you're moving along. And as you see on the right here, there's a car and there's different arrows moving in different directions. So what you see in your dashboard will help you make a decision potentially about whether I have the ability to make a left turn or right turn and get to my eventual location. So the financial statements can provide you with some great information, and we're going to do a deeper dive on what that really means. But before we get there, we really want to talk about the different statements and what they really mean, and what they can give you. So some of these slides you'll recognize if you were on the broadcast last week. So we talked about 3 financial statements: the income statement, also known as the P&L, profit and loss statement. We talked about the balance sheet, and we talked about the cash flow statement. So we're going to revisit some information, but take a deeper dive on each of the financial statements. So your income statement, or P&L, it's a synonymous term, is based upon a period of time or activity over a period of time. It might be a quarter, it might be a half year, it might even be a month, and it might be a year. When you put your income statement together, you want to have all these components that are listed here: your revenue or sales, your direct cost, your gross margin, and we're going to talk about each of these, your operating expenses, and net income or loss before taxes. And one of the concepts I want to talk about right off the bat is also in your income statement, the concept of accrual versus cash accounting. So the best way to illustrate that is a business, and we'll start with a cash-based business. So if you have a business that generates cash sales either through credit card transactions or cash purchases, that's really a cash business. When the money comes in on a certain date, and you incur expenses, that's the way you account for them. In accrual-based accounting, which is typically the way most income statements are put together, under that type of accounting and accrual accounting, you actually, if you're a service-based firm, you count the service or count that revenue generated from the service when you complete the service. If you are a product-based business, you complete, you count that revenue in a product-based business when you ship the product out. That's when you count the revenue. So for instance, if you ship 10 products that were each cost $100, that's $1,000. So once you ship it, you could then count it in that given month as revenue. And what you see on the right here is kind of a synopsized income statement. Each of the terms are specific to, and each of the terms have relevance based upon whether it's an expenditure or whether it's revenue. So a revenue or sale, some of the things you might subtract from that above the direct costs might include things like discounts. It might include things like returns. Your direct costs are the cost of actually generating those revenues. So if you're making a good, a product, then it might be materials and labor associated with making that specific product. If it's a service, you might have subcontracted people that you hire to perform the work. And that's where you would subtract that off. It would be a direct cost, and then any costs associated with generating a product or producing a product and selling it is cost of goods sold. Once you subtract off your direct costs, you then have what's called the gross margin. That's not your bottom line profit, but it's your gross profit. And then from there, you subtract off your operating expenses, and then subsequently you end with your net income. So we're going to talk a little bit about more in detail, and also make sure that all of us know the terminology here. Eric, do we have any questions so far?
No, so far so good. I guess everyone's just thinking of their questions right now.
Okay. One thing I want to emphasize too, and I didn't say it up front, is that don't feel as a business owner you need to be a CPA or a specialist in these income statements. It's about taking in enough information and understanding enough information to make decisions in conjunction with the team that you put around you, your advisory team. So what I want to emphasize here, it's important that you understand the terminology so that you can speak and understand the language, but you don't have to be necessarily an expert in it. And with anything, over time, the more you're exposed to this, the more you will understand and be able to glean information for making decisions. So several things I want to emphasize here. That if you use the term sales and revenue, they're the same. They're synonymous terms. Just like profit, earnings, and income are also the same term. They may be used interchangeably. Revenue and income are not the same. If you look at the example on the right here, revenues are your top line. Your income is the bottom line after you subtracted out your expenditures. So the terminology is subtle, but it is different. And then costs are different from expenses. If you notice on this example on the right, direct costs or cost of goods sold, we use the term cost there. And again, those are costs associated with the cost of manufacturing or performing the service. And those costs are immediately subtracted from your revenues. But it's not the same as expenses. Expenses are related to related to what you incur as part of your operations. So what that entails is things like salary, insurance, marketing. All those costs are operating expenses. You would have those costs regardless of whether you produced any products or performed any services. You would still incur those costs. You'd still be renting the building that you have. You'd still be paying your folks who work behind the scenes, but who are not directly producing the product or service. So there is a subtle difference there. The one thing is also costs and expenses are expenditures. Expenditures is an all-encompassing term that counts both costs and expenses. So as we mentioned before, under accrual, if you have shipments, once you ship something, it is counted as revenue. Orders are different. Orders are on the front end, is when you take orders for your product or service. But with regards to where you count it as revenue, it's only counted once you get to the shipment phase. And then also profits are different than cash. We're going to talk about that in more detail, especially as it relates to the cash flow statement versus the income statement and what information you're going to glean from both of those. Eric, just want to check again to see if there's any questions so far.
No, not yet. So far, so good.
Great. It must mean I'm doing a great job, or either people are asleep, one of the two. So we're going to talk a little bit about the income statement, a little bit more detail here. So what you see on the left here are the components of the income statement, and we're going to dissect it down into a little bit more detail. So on the right, you'll see a typical standard income statement. And as mentioned before, it's titled income statement, of course. And it also tells you the period of time. It's for the year ending December 31st, 2017. You might see it for the quarter ending, or the half year, or even the month ending. This can be put together for any period of time. So again, we start with our revenues at the top. And again, it could be sales or sales revenue, or just the term revenue. Now, the term other revenue can be interpreted in different ways, but one of the ways is interpreted, I'll give you an example. Many businesses, especially in the pandemic, have gone after grants. And grants are considered other revenue. So if you were able to secure a grant, you would list it during that period of time under other revenue. And then again, right before under that line, you'll see it where it says less sale return and allowances. So before when we do look at our net revenues, it says total revenues, but we can also call it our net revenues. If you're producing a product and there are returns, you would subtract those at that point from your sales revenue and other revenues. And then right there where it says total revenues, that encompasses all that math that's involved there. And again, below that, you'll see cost of goods sold, and that is subtracted off, and then you have your gross profit listed below there. And as mentioned before, what you see below that is your expenses or operating expenses. And those are all the things companies typically incur during that period that are part of the operations. So as you can see here, you see accounting, advertising, amortization, bad debt, depreciation, and so on. Just one thing I wanted to point out, you'll see some of these terms and some of these items listed on different financial statements. So you'll see depreciation not only on the income statement, but you'll also see it on the balance sheet. You'll see that term there, and it's the same amount, and they're used on both. As you can see, there's a whole laundry list of expenses listed here. So at the bottom is totaled up there. Our total expenses are listed. And then what we've done, the next line below that, we've subtracted our total expenses from our gross profit. At that point, you're at net income before taxes. Taxes hasn't been calculated into that. Once taxes are then subtracted out, then you have net income, and that's a net income after taxes. Sometimes you'll also see that depreciation not listed under operating expenses. Sometimes you'll see it under net income before taxes and depreciation. So sometimes you'll see it in two different places, depending upon how this income statement is put together. One way I'd like to look at this too is, and I'm going to step back and look at the gross profit. You'll also see a term, and it's not listed in here, but it's also known as the gross profit or contribution margin. And I like to think of that term in that after you subtract out what is taking you to generate that revenue through the costs that you've incurred, the contribution margin basically says, what do I have to contribute to my operating expenses? So I like to think of it in that term. So you'll see gross profit, or you'll see contribution margin, or margin there listed there. How are we doing so far, Eric?
So far, so good. No questions yet.
Okay. I know this is a lot to take in, but if you have questions, there are no dumb questions, because all of us have asked different questions at different times about these different financial statements. So we just talked about the income statement and what that means. We're going to now talk about the cash flow statement. I'd like to talk about the cash flow statement right after we talk about the income statement, because oftentimes this can be confusing. Profitability and cash flow are two different things. So one way to look at the cash flow statement, and the best analogy I can give you, is when you get your bank statement at the end of the month for your business, or even your personal statement. It's basically a cash flow statement. You have money that's in that account that you start with. You have transactions that have happened, whether it be money coming in and money going out. And then after that, you have an ending balance. So what you see on the left side here are all those components related to those transactions that happen over that period of time. On the right, you see a cash flow statement that has opening balance. And then each month, you'll see the same transactions happening. There's a beginning balance and ending balance. The ending balance then becomes the beginning balance for the next month. So let's break down what we have here. So we have a beginning cash balance that we start with. That's money that's already in that account. You have cash receipts with the equivalent of the sales that you make during that period of time. You have disbursements that are made. And in many cases, you're taking much of that information from your income statement. But again, it's not exactly the same. We have a little bit different perspective here. If you've gotten a loan, it might be a disaster loan during the pandemic. It might be a traditional loan that you've gotten from your bank. You have to add that into your cash flow, because when you get that money coming in, it increases your cash flow. As you can see, I've added pluses and minuses here to indicate where there's addition and subtraction that comes into play. And then lastly, you have an ending cash balance. So as you can see here, it's a little bit different. It's very subtle, but there's a difference between your cash flow and your income statement. But there are common line items that you use in both of these that are where there's some commonality. But again, there's very subtle differences. And again, as mentioned before, income does not equal cash flow. And I believe I mentioned this also earlier, a business can show a profit, but you may be hemorrhaging money. You may have some profitability, but when you look at your cash flow from month to month, at the end of the day, you might be on a trajectory to at some point be in a negative position in terms of cash. I was talking to a client yesterday, and I was showing them some sample statements, and showing them with this one business that in the first year they ended up with $480 at the end of the year in terms of their income. But when you looked at their cash flow at the end of the year, they had $404,000. These were sample statements, but they ended up with $404,000 in terms of cash at the end of the day. So while there wasn't much profitability at the end of the day in terms of the business, they were still cash rich. So it's important to understand the subtle differences there and not confuse the two, because there is some difference there and some commonality. Eric, how are we doing?
We just have one question, and I think it's more for Pauline. Could we get a link to the slides or can we get a link to the slides and the information after the session? So,
definitely.
Yeah, so this is being recorded, so it's definitely going to be shared with everyone. Pauline's going to share that, and we can definitely share our slides along. We'll send that to Pauline. I'm sure there's a download system that you guys can set up. Is that right, Pauline?
It is, and probably the best way to do it, if you want it immediately after the session, is to follow up with an email to me. But then what we're planning on doing is actually putting them at the on our website where they can follow the link and download them.
Cool. Thank you, Pauline. And we do have a question. One question is the person says, I use QuickBooks and it breaks all of this out for me, which is great. Is the cash flow statement the best place to look for the health of one's business?
I would say the best way to look at the health of the business is to look at all the statements combined. Again, because each one gives you a different piece of information. One with your income statement gives you the profitability of the business. Your cash flow tells you how much cash you have left over after you've made those transactions. And then lastly, we're going to talk about the balance sheet here. It tells you what you own, what you owe, and then what your equity in the business is. So I think it's important to look at all three. So I'll give you an analogy, a good example here. When you go to the doctor and you see your doctor, not only does he take your blood pressure, your doctor will weigh you, he'll send you out for lab tests that include cholesterol and all those things. Looking at all those pieces of information combined, your doctor can make a decision about your health and the best things that you need to do to maintain or to improve your health. Your business is exactly the same way. All this quantitative information that's provided, whether it be an income statement, a cash flow statement, or a balance sheet, all give you a different perspective, but combined up, they give you the overall view of your company's health. And again, as mentioned before, you can look at one statement and look at your profitability and you're profitable, but you could look at your cash flow and it could be, you could be hemorrhaging money, or vice versa. Your profitability could be low, but again, because of you, if you started out with maybe a strong or had a loan that has propped the business up, you may be strong in cash, but your profitability may be low. So you have to look at all pieces of the puzzle.
Yeah, and then just to kind of tag on to that question and what you said, Charles, in terms of responding to it, I think that's a great response. It's the totality of everything. It's not just one statement. Also, you definitely want to look at the pattern of what's happening. Some of these statements just are a picture in one. They're a snapshot of time.
Mm-hmm.
So let's say, for example, a seasonal business. Let's say a business. Let's look at Chesapeake Bay. Most people, let's say a business, for example, who owns, they do tours on the Chesapeake Bay. They would peak in the summer months and their business would decline in the colder months. We're just making assumptions here. And when you look at it from your balance sheet, a cash flow, your P&L, and your P&L sheets and information, you want to look at it over time, and then you build strategies over time. And I know of a couple of companies who, during the winter, when they have a low season, they pivot their business to actually doing boat repairs. So their cash flow actually isn't a high dip and a high peaks and dips, but they actually are more of I wouldn't say a flat line, but it's much more predictable cash flow because they actually have different products and services at different times of the year. Mm-hmm. So your numbers tell the story depending on your business, but don't look at it from, like what Charles said, today your doctor is looking at you at this point, but then remember, you got to go back and get a second checkup, then get a third checkup, then get a fourth checkup, because you want to see a pattern in your business. So yeah, always, and also make a decision. Don't just look at the pattern and make a decision based on that intelligence that you're gathering.
Definitely. That's a great point, Eric. And we also advise too that if you feel you don't understand what is there, to always seek professional help, whether it be free or paid. And it's important, and I mentioned it before, it's important that when you start putting the financials together in the beginning and setting it up, it's important that the information in your QuickBooks or in any application that you're using is set up properly in the beginning. The worst thing in the world is to set it up incorrectly. You put information in and it's been put in maybe in the wrong lines or so on, And so the information ultimately you're going to get out of it is not good information. You want to make sure you get good information out and make decisions on it. And again, these are snapshots in time. And as Eric mentioned, I think you need to have, a period of months or years to look at things in relative terms. And we're going to talk about some of the nuances there and some of the ways to glean information in a second.
We have another question.
Sure.
I think this person is asking on that example where they had, I think you were talking about the, in their cash flow or in their P&L statements, the example was, I think they had $400 on the paper, but in reality, or something like that. So the question is, why would that happen where there is more cash than profit and vice versa?
That's because they might have started out with a loan where they generated a lot of cash. But if they may have a lot of cash, but if they did generate a lot of revenue, they would have low profitability, especially if their expenses were high. So while they may start out with low profitability, over time they might increase their profitability. But from just a profitability standpoint, where you look at sales generated and then expenditure subtracted, their profitability is low. But they might just have a very large loan that they got up front, where they've been able to have a large amount of cash in the bank. Does that make sense?
I
can't see the chat area, so I have to rely upon your.
No, I think the response was, yeah, that was helpful. That was really helpful. So yeah, so far so good.
Great. So we're going to talk about the balance sheet, and again, there's information that you'll see on this statement that is common or maybe used on the other statements. And the example I used before was depreciation. Now, unfortunately, the example I used here, I don't see depreciation listed. But if you're looking at equipment and so on, the amount that you would see on a balance sheet is typically the depreciated amount after you subtracted out depreciation. And we'll talk about that in a second. So the balance sheet is a little bit more is different than the income statement and the cash flow statement, in that the balance sheet is a snapshot in time. It's basically saying, on this date, here's what I own as a business, here's what I owe as a business, and here's my equity in the business. On a personal level, your net worth is the personal equivalent of a business balance sheet. So if you took everything that you owned, subtracted out everything that you owe, what's left over is your net worth. Now, if we use that same approach to a business, everything that you see are assets that are there. If you subtract out the liabilities, what's left over is the owner's equity, or essentially the net worth of the business. So your assets, we'll start with that first part. The assets can include cash, accounts receivable. So if you are making a product and you invoice somebody, you send it to them and you invoice them, that's counted as a receivable. It's an asset in that there's an expectation that you're going to get paid on it, and that it will manifest itself as an increase in cash at some point. You might have inventories. Inventories are those things you've made the product, but it's sitting in your warehouse. You haven't shipped it yet or sent it to a customer to be invoiced yet. Prepaid expenses. This can be a little bit confusing, but if you've paid for insurance and other things like that ahead of time, let's say it's March, or let's say it's last December, and you paid for insurance for your business for January through March, that's a prepaid expense. You paid for it in advance of realizing the benefit. You can count that as an asset on the balance sheet. And the reason why you see on the right there, you see they're called current assets, are typically those assets are assets that are used within a year's time. You would use your cash, the receivables would change, your inventories would change, prepaid expenses would change, within that year's time. Your fixed asset or longer term assets are things like land, your building, and equipment and so on. Those are the fixed assets of the business that are tangible assets that are I'm not sure if I'm using the correct term, but longer term assets here. So your assets are on one side of the balance sheet. And the reason why I call it a balance sheet is because if you take your assets, they equal your liabilities plus the equity you have in your company. And again, going back to the net worth concept, if you took your assets and subtracted your liabilities, what you have left over is your equity. So the assets much balance against the liabilities and owner's equity. You can see in the example on the right that the assets do balance against the liabilities and the owner's equity that are listed there. And your liabilities are also broken down into short-term liabilities or current liabilities, and they include accounts payable. So thinking this in reverse as the receivables. If they're payables, is what you owe vendors who have invoiced you. So it might be that you've purchased materials for producing a product, and they've invoiced you. Those are an accounts payable. You might have taxes payable that are due in the next period. There might be other liabilities that you might have. You might have business credit cards that you have to pay off. And those are the liabilities that you see here are current liabilities. Those are the ones that typically that are paid off within a year, and that's why they're called current liabilities. You might have a long-term debt. So let's say you see on the asset side, you own a building, but you might have a mortgage on it. That might be that long-term debt that's listed as a long-term liability and makes up part of the whole liability piece. So collectively, you see the total liabilities here are $1,000. Below that, you see owner's equity. So if most small businesses don't have stock. They're not traded on an exchange. But if you're a small business, you definitely would have what's retained earnings. And those are earnings that are basically earnings that are cumulative earnings that the business retains. It's your net profit after taxes that are cumulative for that period. And again, collectively, the equity and your liabilities are equal to your assets there. So what does it all mean? Well, we have all these numbers. We've looked at income statements. We've looked at cash flow statements. We've looked at the balance sheet. Let's look at how we can glean a little bit more information from some of these financial statements. So on this example here, we're going to look at look at the various pieces of the income statement on the right, on the left, and then we're going to break it down by percentage. So we're looking at each of the line items here on the income statement as a percentage of revenue. So as you can see here, the percentages are broken down. And as Eric mentioned earlier, if you look at this on a period basis, if you look at, let's say this is a first year, you could do the same thing with the numbers for a second and third year. And you can glean some information about, well, how much are my operating expenses relative to my revenue that I've generated in that business? Or how much is my gross profit relative to my revenues, and so on. So you can use all of this to glean more information. And what you see on the left here is what's called common sizing. We've common sized the statements, and we've taken the raw numbers and put it into relative percentages. And so from this, you can see that the bottom line here relative to our income statement is that we have a 10% net income relative to our revenues. Now we've done the same thing on the right in the example on the right, and what we've done is we've broken down our assets, liabilities, and equity relative to the percentage in the respective areas. So as you can see, total assets on the example on the right are 1,835,000, and that's 100%. And each component of those assets, whether it be cash, receivables, inventory, and so on, are percentages of the total. And so we can relatively see how much cash we have relative to all of our assets, how much receivables we have, and so on. So I mentioned earlier that we can do industry comparisons. So we might do a comparison related to the industry that this is for this business, and we may find that maybe for a typical business like this, their receivables are maybe 10%. They're carrying a lot more receivables than they should for a typical company of that size. So each of these components will allow you to glean a little information about maybe an industry comparison or where you think you should be, um, um, within that framework. Eric?
Yes, we have a question.
Sure.
How can we gauge if that profitability, the 10% example, if it's good or not, if we can't find industry analysis?
So the good news is there's a lot of databases out there that provide aggregate data about typical businesses. So let's say that you are a shoe manufacturer and you are a small shoe manufacturer and your revenues are $1 million or less. There are companies and databases out there where you can compare the percentages, relative aggregate percentages to your company. And you might look on there and see that, average for companies that are out there, and typically that data is generated from a sample size. So they might be able to get a sample size of say 300 businesses that are similar in size to you, and they compile the numbers and they find when they look at all the financial statements that on average, maybe the net income for your industry is 5%. So you could say your 10% is relatively good relative to industry norms. That might be a comparison there. Also, the net income can also be relative to what you expect out of the business, what your expectation is for the business. Maybe you want to generate, when it's all said and done, 20% net income. So then you have to, if you're looking at it from a historical perspective, then you have to look at the numbers that fall above that. And maybe I need to look at different vendors that are providing me materials so I can lower my cost. If you're looking at your operating expenses, you may need to reevaluate those so that you can increase your net income. Hopefully that answered the question.
Yeah, that's, well, I'm waiting for the person to say if you answered the question or not. But I think it's a great way. It's a great question, because what happens is we also have to remember that when we look at our industry analysis, then we have to understand how those numbers, again, those are aggregate numbers. So this is why when we talk about the business planning aspect, it's always good to really understand your industry and your market. So always do your industry analysis and your local market analysis, because that a lot of the businesses in your geographical area, they're pretty much impacted by the same constraints that, if we're in Bowie, for example, and we're under the pandemic, of course, and you do a raw materials, well, the businesses within 10 miles, 15 miles of Bowie, you're pretty much going to have a good idea of the constraints of your raw materials coming into the place vis-a-vis the aggregate, which means if you have the same business type in California, that's a different aggregate number. I mean, it's a different local number. So the industry analysis is an aggregate number. You want to kind of break that down and try to do some research in the local number. Now, as Charles was mentioning, that 10%, yeah, it seems low. It's a good rule of thumb to look at it, but again, it's case by case. So, I'm like, for Charles, and I'm probably gonna get in trouble for saying this, but when I look at gross profit margin, I always tell clients it's let's get to 25%. What are strategies that we can get to 25%? Even though the example says 10%, immediately, and Charles did this as well, I noticed, he's like, that's 10%. How can we get that number up? Yep. So like Charles mentioned, how do you look at some of your vendors? Could you increase your price a little bit? Could you look at some of your online expenses? I mean, you look at everything to get that number up, and that's what you do. So the numbers tell the story. So I'm
And
sorry,
and,
Charles, go
and the,
ahead.
and the oh, that's some great information, Eric. And you hit the nail right on the head. It's really, when you look at it from a historical perspective, if you're an existing business, you want to be looking at these numbers constantly, because there's always room for improvement no matter what. There's ways that you, as you said, maybe your pricing is low relative to your competitors. You can increase your price a little bit and still, make a decent revenue. Um, Again, your cost of goods sold, maybe it's the fact that you are using vendors that, they were giving you great prices 2 years ago, but you're now in your third year, they're not giving you great prices. There's some other vendors that are willing to give you the comparable materials at a much lower price. So you constantly want to look at those things to see how you can make improvements, over time.
Okay, so we have a question. So the question is, it's related to what we're talking about, the industry analysis.
Mhm.
So aside from search engines, do you have specific websites that we can recommend to help people find their industry analysis?
Sure, there's some databases. Um, Typically, most libraries have some good small business databases. Many of you have heard of the company Dun and Bradstreet, and many of you associate it with the Dunn's number. It's the business equivalent of a Experian or Equifax and so on, that monitor business credit. Well, the way Dun and Bradstreet makes their money in many cases is providing aggregate industry data, compilations of data about industries, and companies pay for that information. But again, I would start with your library. There's many good databases there that has data like that, and they have databases. Most library systems have a business specialist that will help, guide you or help you find that information. And there's organizations such as the ones that Eric and I work for, Small Business Development Center, Women Business Centers. They can do industry reports or pull reports that can help you, get information where you can get industry data.
Yeah, that's a great suggestion, Charles. Um,
Always start free and then work to paid.
100%. So depending on the type of business that you're in, also look into that industry specific business that you serve in your market. So, for example, the person who asked the question, they say that they're looking for certain body piercing supplies. Well, just for that example, I would probably start looking into manufacturers of those body piercing supplies, right? So whatever supplies that you have, like ink or needles, like that, for tattoos and stuff, you know, there's someone who's making them. So see if you can find out who's actually manufacturing those particular items and then start there. And you may even negotiate a price directly with them as a suggestion to see if you can reduce your overhead costs instead of going to a third party or even a fourth party, like walking into a store and buying your materials, because they're obviously they're upselling and upcharging the equipment to you. Go directly to the manufacturer. It's as simple these days as making a call. It's as simple as connecting with on social media and just sending them a message saying, "Hey, I do this. How much could I talk to you about buying directly from a manufacturer?" So those are things that you can look into. We go beyond internet searches, like Charles said. We can go to the library, or we can go virtually to the library these days because of the pandemic, but also local universities. Look at Howard University in their business department. Sometimes you may have to pay a fee to go online and maybe get their library resources if you're not a student. But call a business professor. Go to your Maryland SBDC, go to the DC SBDC. The resources are there, and believe it or not, another great resource that you might look into, it doesn't matter what business you're in. If you know another business owner in the exact same market and the exact same business that you're in, create a relationship. If you create that relationship with someone else who's, let's say if you're a baker and 5 bakers come together and they all start buying wholesale as 5 bakers, you drop your overhead price. It's like family shopping at Costco. It's the same thing. You split the cost and you reduce your personal overhead. So just think in different ways to leverage what Charles is saying in terms of looking at how to improve your net income percentage by reducing overhead in certain areas.
And this data can be used not only for existing firms for comparisons, but if you're just starting out, you can find some of this data. So as you create your spreadsheets that might include your income statement, your balance sheet, and so on, you can look at this to kind of level set or create your projections based upon what's out there in terms of the industry. And you can also look at it from that perspective.
And that was the last question, Charles. Thank you.
Great. So what does it all mean? We've talked about decision making. We've talked about what we can use it for. Well, some of this information that we see here is information that is not only used by you to make decisions as a business owner, but it'll also be used by the bank. But the bank will not only look at this data, they'll do some deeper calculations. And these are where we get into, we just talked about common sizing. We're going to talk now a little bit about ratios. So when you go to a bank and they're evaluating you for a loan, they're going to look at your financials and make some calculations. And based upon those calculations, it might incentivize them to give you that loan or to not give you that loan based upon the values. So these are 3 sets of ratios that are typical ratios. There's more out there, but these are typical ratios that you might see. So we talked about current assets. We talked about current liabilities. If you do basic division, your current assets divided by your current liabilities, that's called a current ratio. Now, obviously, you want your assets to exceed your liabilities. So, when the banker looks at that, they're definitely looking for a number that's greater than 1, and preferably much higher than just 1. A quick ratio is the cash plus your inventory divided by your equity. And again, that should also be greater than 1. And again, these are liquidity measurements that the bank takes to make a decision about whether they're going to lend to you. So if you produce a product, the next set of ratios are both ones that you may use to make decisions or to analyze how well your company is doing, or again, it might be analyzed by others and to make decisions on. So in this case, industry turnover, asset turn ratio, and receivable days are all asset management ratios. How well are you managing those assets essentially? And what does it mean? So again, you're taking information that you have from your historical balance sheet, or they may be information that you're taking from a forecast that you can plug in here that will give you information. And again, very much like the common size information that you'll find, there's also industry statistics related to all these types of ratios, whether they're liquidity ratios, asset management ratios, or in the last case here, profitability ratios. So if there's no question, I'm going to slide on to the next.
No questions. No questions.
Great. So one of the things we talked about last week is the importance of the team, and I'm going to revisit this in terms of the role the listed team here can play in terms of helping you and your business. And this may be repeated information from last week. The bookkeeping aspect in terms of an advisory role or in terms of somebody, an individual or a firm that might help you, they serve to help you with your everyday transactions. Their role is to help you take that information, put it in the right spots in QuickBooks or whatever program that you might use to help put that together. They might even set the books up for you prior to that. So once that is done, then they plug in the right information based upon the information you provide them. So that's the function of the bookkeeper. The accountant, and sometimes the accountant and bookkeeper be one and the same, but in an ideal situation, you separate the accountant from the bookkeeper. The accountant's role is to be the check and balance with the bookkeeper. You want an extra set of eyes there just to make sure things have been done properly. And, God forbid there's any type of finagling done with the books. You want to make sure that accountant is there to help and identify where there's problems there. So that's a separate role in and of itself. Your accountant is not necessarily someone that you would use on a constant basis. Your accountant might even provide your bookkeeper, but they also may, the accountant themselves might take a look at your books periodically. The tax advisor is another role. And what I tell small business owners is that the tax advisor is not just there to go to, at the end of the year, and you have your transactions in hand to help you do your taxes. They also serve in an advisory role, and their role in that sense is to, look at how the business is doing over the course of the year and help provide tax information or tax advisory to help you make decisions. So I'll give you an example of that. You've done a great balance sheet. They see that you have a lot of cash on the balance sheet. They might say, well, or you have a large, you're very profitable. They might say, well, you have a lot of cash on hand. You might want to maybe invest in additional equipment or invest in some other things to help you generate additional revenues. So your tax advisor doesn't do that when you go to them to do your taxes. They're going to give you that information somewhere over the course of the year before you get to your tax time to help you make a decision based upon that. And again, they're going to use the information they see from the books that have been put together, whether it be the income statement, your cash flow statement, or your balance sheet. Your financial advisor is more on the periphery. That's the person that's going to help you set up a retirement plan, because you might have a legacy business you want to pass over. You might want to retire from the business. You might retire and shut the business down. Your financial advisor is there to help you make decisions relative to what you're doing outside of the day-to-day, month-to-month, year-to-year services that the bookkeeper, accountant, and tax advisor provide. So they're there to provide you with that perspective, retirement and other aspects, related aspects. They might even set up a retirement plan for your business. And legal, of course, they handle your contracts. You might have an attorney that deals with the tax piece, also where there are legal implications. So they're part of that advisory team that you want to have in as part of your team. And of course, information technology. We're now in an age where everything is done on computers. So it's important that you have that technical person there to help you make sure that your systems are working well, that, they may provide advisory in terms of systems that can work together, and that may need to interface together. So it's important that you have that person there. And there's others that aren't mentioned here that become important part of your advisory team. But again, the first four that you see listed here, even the fifth one, the top five here, they all will use the information we just discussed in terms of your financials to help make decisions about your company. How are we doing on questions, Eric?
None so far. So far, so good.
Great. So one of the things we talked about last week, and I'm bringing this topic in again this week, is doing a SWOT analysis. And the SWOT analysis is four aspects or four analyses of your business. And it talks about what are the strengths of your business, what are the weaknesses of your business, the opportunities there for your business, and the threats to your business. Working hand in hand with financial data, these two pieces can help you make decisions about the business to moving forward. And you might even do this analysis whether you are just launching your business or whether you're at some subsequent phase of the business, whether it be in growth, shakeout, maturity, or hopefully not decline of the business, but hopefully a life cycle extension of the business. So when we do a SWOT analysis, I like to call it a back of the napkin analysis. It doesn't require a lot. You can do it on a piece of paper. But when we look at the strengths and weaknesses of the business, that's internal to the business itself. If you think of the analogy of the business being the room that you're in, it's the business itself and nothing beyond. If you look at opportunities and threats, those are everything that exists outside of the room. In some cases, it may be outside of your control, but it may not be. So what we like to do is take a laundry list or make a list of those things that are strengths of the businesses. And again, this is to help you make good decisions about it. So in the finance area, in terms of the strength of your business, you might look at your balance sheet or your profitability or your cash flow and listed. And there might be a strength there that you want to list as part of your strength. We're cash rich or cash strong. Human capital. Do we have a good team inside or even external, your advisory team? You're going to do some analysis about your operations. Your financials may show that maybe your operations isn't as efficient as it could be. So you might want to do some modifications there. But you want to list that either as a strength or a weakness. And you might have an intellectual property, which means you have some type of tool that you've patent, trademark, or copyright that helps the business and is a strength that you have in terms of your operations. On the weakness side, those things can still play on the other side where there's weaknesses related to the topics that are strengths. You may not be in a strong cash position, or from the analysis that you've done financially, you realize that your operations are not not in a good position, or your marketing or other areas of the business. The opportunities there, you may look at and realize that at your sales and realize there's one target market that you have that's really going gangbusters and you want to focus on that. That's an opportunity. That's external to your business. And there may be other aspects of opportunities you want to look at. There also may be threats to your business, and typically that's identified as competition. You might use your financials or other information that you have to glean those threats. And they could be, as mentioned here, in the environmental regulatory area. When we look at our strengths and our opportunities, those are areas we want to leverage. When we look at our weaknesses and threats, those are areas that we want to help mitigate. We want to put a plan in place to help address that. So for instance, if you are in a weak financial position, you've looked at your financials, either pro forma or historical, and you're in a weak position, you may need to look at getting a loan. So that might be one of the considerations there. So your SWOT analysis, again, is a back of the napkin analysis, very simplified bullet point analysis. It can be more in-depth, but it can be a bullet point analysis that's done. And it's there to help you, again, hand in hand with your financials, make decisions. Your SWOT, and Eric will probably back me up when I say this, it's good to have a third party do this and have them act as a facilitator for putting this together, because they can pull information from you that's in an objective fashion, where if you try and do it yourself, and you can do it yourself, but there may be some subjectivity to it. So it's good to have a third party come in and help you put a SWOT analysis together, as with what we discussed earlier in terms of the financials. And again, as mentioned, you can utilize the SWOT at any phase. You can analyze your situation, whether you're just looking to start the business or at any subsequent phase of the business where you need to make a decision. Any questions so far, Eric?
No, none so far.
Anything to add? Because I know you're the SWOT king.
No, I totally agree with you 100%. And having someone else help you with the SWOT. It's good to do it on your own initially, but if you really want to dig deep and really, I mean, when we talk about our strengths, as we're all human, our ego gets in the way. Oh, we're really strong, but when we start talking about our threats, we're not honest about that. Let's just be real. We don't want to talk about our weaknesses or our threats, because it's our ego. So you always, like Charles said, you always want to have a third party. You want to have someone who is going to push you and ask those questions. And on Charles' list earlier, he talked about those 5 or 6 people that you should work with, your financial advisor, your business banker, your business lawyer, and also your business counselor, your business coach they're the ones who are really going to push you and ask these questions. And you may not like what they ask. It doesn't matter. This is what's important is the stronger your SWOT, you realize at this juncture in time, this is where I am. And do another SWOT, like maybe every quarter or every 6 months or once a year. Do a SWOT again. It's a great exercise, not just to look at your business, but to also look at yourself personally. Because honestly, do a personal SWOT too, because this gets into your personal SWOT as well. So
Definitely.
do these things with someone that you trust and someone that understands the whole SWOT analysis and understand your business and understand that market where they can push you and make you think a little bit differently and kind of get you out of your comfort zone, because you don't want to be in a comfort zone. You don't want to be there. You
And
always,
Eric, you'll probably agree too that especially for companies that are going through the pandemic, this tool can be so important because, when the pandemic hit, one of the first things that happened is, what do I do? So the SWOT can be a great tool for saying, okay, I'm in the midst of this pandemic. What do I do? You do the SWOT, and it may cause you to pivot the business. It may cause you to reevaluate the business that you're in. Hopefully you can continue on with the business, but it can be a really important tool right now, especially if you haven't done one and need to make a decision during the tough times we're going through.
oh, you said it. That's you perfectly said. I can't add to that. Great idea. Just, yep, do it.
Yep. And again, I want to emphasize that it's important, if you're an existing business, you can use your financials as part of the information that you put into your SWOT, in terms of your strength, your weaknesses, and so on.
Oh, we have a question.
Sure.
Who is the best person to give you the most focused SWOT analysis? Is it the tax accountant, the tax attorney? I would think multiple perspectives could be confusing.
Yeah, I think if you're a business, and again, going back to the resources that are available out there, I would go to your small business development center, start there with a counselor who can, through a course of the conversation, can evaluate based upon what you tell them, help you get through and do a SWOT to help you see where you are and what changes you need to make, moving forward. So I would start there, but then also you could take that SWOT and then work with those different components, as Eric suggested, to help you get a perspective evaluation based upon their specific specialty and how they can help you, again, mitigate your weaknesses where they relate to that specific area or address the threats.
Mm-hmm. That's actually a great point, Charles, because definitely do work with a business counselor, a business coach, or a business consultant to help you with the SWOT, because they look at things across the board of your business plan from beginning to end. I would even say, if you want to look at a financial SWOT, if you really want to break it down to a specific area, if you want to look at the strength of your finances, then take it to a financial planner or a CPA or accountant, and then say, hey, what is the SWOT of my finances? So you can use the SWOT, generally speaking, for the entirety of your business from a business planning perspective, from beginning to end. But if you really want to say, okay, what's my SWOT in terms of a legal perspective, then you would take it to an attorney. But then remember, that's a SWOT just for legal perspective. But if you want a general 30,000 foot level perspective, then take it to a business coach, a business counselor, a business consultant who can look at all aspects and then say, you know what, I don't know your legal aspect. Let's try to find this out. Let's talk to a tax attorney. That would be a weakness. And then your leverage to that weakness is, let's talk to a lawyer. That's your opportunity. So there's different ways of looking at it. So I hope we answered your question.
Yeah. If I could also add too, Eric, this is a little bit off the subject we just talked about, but I wanted to point out that this curve, or this a graph that you see on the right here is not every business. Not every business looks like this, but this is typically the way, depending upon the phase of the business, a business life cycle looks like, typically. And if you notice here, and that we're talking about sales, cash, and profit, what do these all go to? If they all go to the income statement or the cash flow. So I just want to point that out of how all this information ties in and how important it is to have really good numbers. So I'm going to summarize here. We're going to take some more questions, but again, in summary, as mentioned before, I think it's important to set up and develop a strong financial platform. Start with a good program, start with a good advisor to help you set that platform up, whether you may start with a counselor or an advisory, one of the advisory folks we mentioned before. It's important to understand the language of financials, because that's important. If you notice, we talked about, revenue versus net income. They are different. Cash flow versus profitability. There are subtleties there, not only in the language, but in the meaning and the overall sense of what it provides to you in terms of information. Have checks and balances built in. And we talked about this relative to having a bookkeeper and an accountant as a check and balance. Leverage historical and pro forma financials for decision making. Again, if you're an existing business, look at the trends. Eric mentioned it earlier. Look at the trending of the information that you can glean from your financials. What does it tell you about your company and decisions that you may need to make? If you're a new firm or a pre-venture firm, you may use your pro forma financials to give you a sense of where you are. And also, when you put that first set of financials together, they may not be exactly what you expected. So you may need to maybe increase the revenue you project. And again, we talked about it earlier, maybe looking at different vendors to lower your costs, whatever it might be. So again, the information is very, very important. Engage third-party resources for assistance. And again, this could be free or it could be paid resources. And your free resources can also tell you when they think you need to bring in somebody who's paid, and vice versa. And lastly, and it dovetails into the next to last bullet, have the appropriate advisory team in place. Now, with that being said, I wanted to provide a suggested reading list that I found helpful. Financial Statements by Thomas Idelson is definitely a reference book you want to have on your desk. In the book, it gives you all the terminology and how the different statements relate to each other. The back part of the book gives you some solid examples of how to apply the principles in the front part of the book. So it puts actual numbers and provides some information there. If you have a nonprofit, this is also, Idelson has another book related to nonprofit accounting and financial statements. There's some subtle differences there, both semantically and in formatting those statements, financial statements needed for a nonprofit. So he talks about that in that book. And also basic budget basics. About there, you want to establish a budget up front, and look at over time. Once you establish a budget, how do you vary from the budget over time once you get into the actual operations of the business? Good book there. Target funding for those who are just starting out, or even if you've already have an existing business. Target funding can provide some great information about where you can look for sources for money. Lean Business Planning, more of a process book, but it also talks about financials in there. By the way, Lean Business Planning, Tim Berry, the author there, he's the founder of Palo Alto Software, who makes LivePlan. It's a business planning software. And lastly, The 5 Choices by Kerry Kogan. Great book in terms of productivity and increasing your productivity and helping you be more efficient. So a little bit of a cross mix of books, but all of them give you either something about financial statements themselves, sources of money, or productivity. So with that, that's the last slide for the presentation, and we're open for any additional questions that we have.
So far, no questions. But yeah, I like your book list, because there's so many resources out there that folks can go and sort of take a look at and reference all this material in terms of how to put things together. But always remember that you want to relate it to your specific business. You want to, a lot of the information out there is really good. It's really good stuff. But you always want to find that assistance who can take a look at your specific area and into your specific book, and then not book, but into your specific business and relate it on that level.
Definitely.
So yeah.
Definitely.
Yep.
And again, I can't emphasize enough that I don't want any of the businesses who are listening to this feel that they have to be an expert. You don't have to be a CPA. But again, the key is understanding the language of financials so that you can make good decisions, or know at that appropriate point to go to the person that has the information to help you make those good decisions.
Yeah, most definitely. And you definitely want to find someone, as Charles mentioned, a business counselor within your, because Maryland has an SBDC, DC has an SBDC, Virginia has an SBDC. You know, we're doing this in Maryland, so you definitely want to reach back and find out, you know, what are some of those, I don't want to say free, because it is a cost to it, but it's no cost to you. But then you want to build your business where you want to create an opportunity to actually hire someone on your team who can actually take you to another perspective, or another level of echelon in your business. Because those resources, we take you to a certain point, and then we actually take you to another point. Like, for example, I'm a business consultant as well, and Charles is also a business consultant. You know, we, depending on where the business is, we meet you there, and then we sort of triage you into say, okay, this is where you need to be, and this is how you can grow. So yeah, this is all part also of the 24 webinar series. Just come back next week. You know, and you have Charles's contact information, you have our contact information. So always feel free to reach back to any of us and ask these questions. You know, don't just think that we're here for this hour or 2 hours, but just go back and find us, and it will be there. So before I turn over to Pauline, Charles, any final comments before I jump in real quick?
No, I think you covered it, Eric. I think one of the points you made is definitely a very salient point. It's important to recognize the continuity of all these webinars, that the information each webinar is tied to the next one, and you're going to get a different perspective or some additional information that builds upon what you've already found in the previous webinar. But it's important to you won't learn this stuff instantly, but you'll be exposed to it enough over the course of all these webinars so that you can make some really good decisions and have a good knowledge base.
Yeah. And with that, Charles, excellent point. And with that, I'm gonna start a quick PowerPoint slide. And what I would like to do is, just with Pauline's permission, share my screen. And as I said, you know, in building these 24 webinars, you know, Charles, you know, I started off with business planning and goal setting. Charles came in and just hit another home run with financial literacy. Next week, we have Mr. Manny Cosme. He's a president and owner of CFO Services Group. He's based in Washington, D.C. He's a CPA accountant. He's an accountant as well. And he's going to be talking about updating all those documents that Charles took us through. He's going to bring all that together and talk about financial projections and actually giving strategies and tips to grow your business through financial projections. What's interesting, we had a lot of questions last week, Charles, if you remember, about what software should I use, QuickBooks or, well, out of CFO Group, Manny's coming back to the chamber on May 6th and May 13th, back-to-back QuickBooks sessions. So he's going to dive into, this is how you use QuickBooks for your business. And, I know we're doing it in May, but that's part of this whole webinar series. We're building up, one webinar to the next, to the next, to the next. So we're going to get into some operation stuff on May 6th and May 13th with Manny. So you definitely want to be here next week, because he's also going to, talk about QuickBooks a little bit and from a projections perspective. So you definitely want to be here next week, and just sign up. I guess you can sign up now, right, Pauline, on the website?
I believe you can.
Yeah.
Correct. Tomorrow there will be you can search Eventbrite, but tomorrow there'll be a flyer with a link in it.
Cool. So the minute you get the flyer, just go ahead and register for it. Just like you registered for Charles's webinar tonight. So go ahead and register for that the minute you get it. And please do share this with your fellow business owners, and do share this with your friends and family, because QuickBooks, you can actually use it for your personal financing. You can actually do projections on a personal level, especially during this pandemic. It changed a lot of our numbers, believe me. So you definitely want to take advantage of these webinars that are no cost to you. So with that, Pauline, I'm going to stop sharing and I'm turning it over to you. So thank you everyone for showing up. Charles, amazing. Thank you.
Thank you.
I'm always
Eric,
impressed.
thank you. Pauline, thank you.
Yeah.
By the way, I was going to say, Manny, I've known Manny for a couple of years.
Yep.
He has a great newsletter too that he puts out. I always learn something new in his newsletters.
Yep.
Okay, we'll definitely ask him to circulate that when he
Yeah,
has a
definitely.
session next week.
Definitely.
I am going to put a poll up. It's just a closing poll. So as we close out the session, if you don't mind, there's about 6 questions to answer. It just kind of helps us stay on target and to know if we're hitting the right issues with you. But another fantastic webinar from 1917 LLC. And Charles, always a pleasure. You've just got so much energy and knowledge in there to give to us, and I appreciate that.
Thank you, Pauline.
And also thank you, William. Appreciate you too. And again, with the pandemic, now more than ever, we really do need business plans. We need to understand what we're doing, just simplified. So again, thank you. Appreciate both of you very much. And with that, it concludes our event. So as soon as, thank you for filling out the exit poll, and we will see you next week.